Traders anticipating a new era of lower interest rates and cheaper oil helped push Wall Street to record highs overnight. The S&P 500 hit an all-time intraday high above the 6,100 milestone following comments from U.S. President Donald Trump at the World Economic Forum. He said he would demand an immediate drop in borrowing costs. The Dow and the NASDAQ both ended in the positive for a fourth straight session. Energy stocks tempered some of those gains, with the S&P 500 energy sector on track for its worst weekly performance since late December. Mr. Trump also told Davos business elites he plans to ask Saudi Arabia to lower the price of oil to dampen inflation. His speech comes just before the Fed's meeting next week, where they are largely expected to keep interest rates unchanged. There have been concerns that potential sweeping tariffs by the Trump administration could add to inflationary pressures and slow the Fed's policy easing path. For more of the markets, we have Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Thanks for your time, Thomas. So gains for Wall Street, but it's really been concentrated in a very narrow part of the market, despite expectations of growth under the Trump administration. So do you think it's time to move on to other previously unloved parts of the market, or is it time to bet on these tried and tested names because of the uncertainty that we might see?
Well, Sarah, I think what you saw today, and thank you for having me, by the way, was a continuation of a trend that started last July, which was the broadening of the market, what I call the unmagnificent 493, everything other than the magnificent 7 in the S&P 500, really started to outperform up until December. And right after the election, and with some Fed uncertainty in December, Mag 7 came back abruptly in December. But now we're seeing a resumption of the trend. The last shall be first. Those sectors that underperformed last year are beginning to outperform. And you saw it. Healthcare was up today. Industrials were up today. Materials were up. And guess what was down? Magnificent 7. And that's the type of economy that we had under Trump 1.0, was a broad participation of regular everyday businesses starting to flourish, from deregulation, from lower taxes, from lower energy, more abundant energy, and less regulations.
Yeah, speaking of energy, we've heard his comments about how he plans to lower oil prices, which could counter the inflationary effects of tariffs. Producers, though, of energy, they won't be happy with that plan. How realistic and how effective do you think these measures will be?
Well, I think he is going to be able to lower it short term. And I think the producers will be okay with it, because the demand for energy is going to go up so dramatically with all the demand from AI, from the AI investment and data centers and the required energy. We're going to need all the energy that we can possibly get, whether it's natural gas, whether it's oil, whether it's coal, whether it's nuclear, whether it's renewables. Everything is going to be part of that pie. In addition to lower energy costs to reduce inflation, there is expectation that the Department of Government Efficiency, DOGE, will maybe not get $2 trillion of cuts, maybe not even get $1 trillion of cuts. But if they start to move towards $500 billion of cuts, it's going to signal to the market that this administration is serious about fiscal responsibility. And as a result of those actions, what you're going to see is the market is going to bring interest rates down versus Trump simply demanding that interest rates go down. The market is too big for any one of us, that's for sure.
Yeah, speaking of interest rates, we're also looking ahead to the Fed meeting next week. How much of the Trump factor do you think will fare into their assessment and their moves when it comes to policy?
Yeah, I think there's a 0% chance there will be an effect in policy for this meeting. However, if you recall, the boat had shifted after everyone had shifted to one side of the boat after the December meeting, and that is people expected 1 to 0 cuts, and some people are even talking about hikes until we got those inflation numbers. And now the market is more in line with the summary of economic projections that we got from the Fed at the last meeting, which is 2 cuts for 2025, but sometime later in the year, if not March, probably June, and then September is more likely. But I think the market is now aligned with the idea of 2 cuts versus this concept that maybe they were going to hike. After we saw the inflation numbers, it put the market at ease. And I think that will be reflected in some of the commentary coming out of the Fed. Certainly very unlikely that we get a cut this month or sooner than March, but more likely second half of the year, 2 cuts for sure. And that'll be positive for interest rates, debt refinancing, and the U.S. net interest payments, which have gone from under half a $500 billion to over $1 trillion. So we need to get that under control.
Yeah. Speaking of rates, the U.S. 10-year yield gaining before the Trump inauguration. Now, where do you see U.S. 10 years headed?
I think this is very similar to what happened in 2016, Sarah. After the election, the rates went up dramatically. After the inauguration, they really rolled over and came down quite a bit in the year of 2017, his first year of his first term. Same thing with the dollar, rallied after the election, and then after the inauguration, weakened quite a bit, and international stocks did well after the inauguration part. So I think we have the exact same theme happening. Rates went up, dollar went up. Now it's after the inauguration. They're starting to come in a little bit. I would expect to see that theme, which very few people are positioned for. A lot of people are crowding into a long dollar, crowding into short bonds. I think you want to be on the opposite side of that trade. Yields lower, dollar lower for the next 12 months, and that will take a lot of people by surprise, but it will be good for the global economy, good for the U.S., good for markets.
Thomas, we'll see how it all pans out. Appreciate your insights. Thomas Hayes there, Chairman and Managing Member at Great Hill Capital.